recorded for note-taking and coaching purposes.
Hi, everyone. Thanks for joining the monthly GovInvest webinar. We'll begin a little after 11. Hi, everyone. Welcome to the GovInvest monthly webinar. Again, we'll probably be starting a minute or two after the top of the hour to let some folks join. Thanks. Hi, good morning, everyone. Welcome to the July GovInvest monthly webinar. This month, we'll be reviewing the CalPERS investment return for fiscal year 1920. So today, my name is Max Stoff. I'm on the customer success team here at GovInvest, and I'll be helping moderate, and the presentation will be led by Ira Summer, our senior public finance consultant. And before we actually dive into the webinar itself, we'll go over a few housekeeping items. So at the end of the webinar, we'll be sending out materials likely tomorrow or the following day. You'll be able to have access to both the slide deck as well as a recording of this webinar. In terms of questions you might have during the webinar or after the webinar, during the webinar, you can use the chat feature in the Zoom site to ask questions, and we'll do our very best to answer them as they come in. Any questions that we don't answer during the webinar, we'll note and reach out to you individually to answer. And if you have questions following the webinar, don't hesitate to reach out to me directly. My email is max@govinvest.com. Our next webinar will be August 15th at 11 a.m. and you can expect more details on the topic of that webinar to be announced shortly. And with that, I'll turn it over to Ira.
All right, thank you, Max. Our agenda for today, we're going to be talking about CalPERS Investments, what happened in the year that just ended June 30, what drove these returns, how they compare to what's happened in previous years. Then we'll take a look at how CalPERS has done historically compared to other retirement systems. If you're wondering, is CalPERS doing a good job? We'll try and answer that question. Then we'll try and take a look towards the future, let you know how this year's returns will impact the contribution rates that you will be paying, and some thoughts about what we expect to start seeing in the next year, the next couple of years, coming from both because of what's happened, some of the things that have happened this year, as well as what the impact of COVID, and as well as what CalPERS has on their list of things to do. I do want to let you know that just like many of you, I am doing this from my home rather than in an office someplace. And I think the person next door heard about the fact that I was going to be running a webinar now and decided to start construction this morning. So if you hear any of that, I apologize in advance. Okay, so let's give you the short answer, which is this year, CalPERS earned a 4.7% return for the 12-month fiscal year ended June 30, 2020. So for those of you, that's all you cared about. That's it, we're done. That's the information you needed, you can run off. And if you have been, somehow, on, off on vacation, someplace, maybe on another planet, or hanging out with Santa at the North Pole, you just, this is basically looks like, oh, it's a slightly bad year. For the rest of you, you know that this was a really strange year. A lot of volatility going on, a lot of things to talk about for this year. So let's start breaking them down. First of all, let's talk about why CalPERS got that kind of return. So a large portion of investment return is driven by asset allocation. What asset classes the CalPERS puts their money in, or any public agency puts their money in, tends to drive 90+% of their investment return. So what you can see here is that 50% of CalPERS assets are in equity, 35% in market cap weighted, 15% in factor weighted, another 28% are in fixed income. These are the major asset classes that you see most pension funds, most investments put into. CalPERS also has 8% in private equity, They also have a chunk of money set aside to be ready to be put into private equity, looking at opportunities to invest. And we'll talk about this in the looking forward, but private equity is the asset class that they expect to get the best returns from over the next decade. And so this is one where having a lot of cash available to be able to take advantage of those opportunities is one of the things that they have been focusing on. They have 13% in real assets, things like properties and other things that tend to have a combination of appreciation as well as regular income from things like rent, and 1% set aside for liquidity to be able to make sure that they can make payments to your retirees on a regular basis. That is their primary job. Their primary focus is to make sure that they can guarantee that they are making payments to retirees, and they have always made payments to the retirees that they are required to make over time.
And Ira, in the news, when we hear financial markets referenced, typically we hear it around either the performance of the S&P 500 or the Dow Jones Industrial Average. So when trying to contextualize those news updates in the context of CalPERS, what should folks be focusing on?
Well, this, again, especially if you've been hearing this year a lot about the S&P 500, the Dow, you've been hearing about how volatile it is. So, you know, each asset class gets a different type of return. So you shouldn't necessarily just focus on the returns in the public equity market. Looking here at the different asset classes, what we're showing, what that CalPERS showed, we'll start with the one-year returns for this past year. Public equities earned 0.6% for the year. I'll talk in a moment about the wild ride they went through to get to 0.6%. The private equity market lost 5% this year. Fixed income earned a positive 12. Basically, when the economy started tanking, the Feds dropped the interest rates down to 0. Lower interest rates increased the value of fixed income. So fixed income balanced off a lot of what was going on, and the fact that CalPERS has 28% of their money in fixed income meant that this was very helpful in driving their returns this year. Real assets earned 4.6 for the year, and their liquidity basically is their risk-free investments are steady at 1.6. Now, if you take a look over time, this year, it looked like, oh, they probably should have been out of stocks. Why aren't they all in the bonds? Bonds are great. Over time, looking at the 5-year period, you'll see that stocks did a little better than bonds, that we have different returns over time. Going back over the last the last 10 years, you'll see that the stock market, public equity, private equity, got the strongest returns. Over time, we expect the stock market, the higher risk investments, to do better than things like fixed income and liquidity, which are less risky investments. If you're taking more risk, you are expected in a normal market to get a higher return from taking that risk. You're rewarded with that. And we're seeing that over a 10-year period. We would see that over a 30-year period. The 20-year period had 2 market crashes in there, and we'll talk about that in just a moment.
And Ira, when we're talking about asset classes, we already got a question from the audience. Can you talk a little bit about how CalPERS could be looking to move into getting into private banking, and what that could mean for investment returns, and what that move might mean for agencies listening into this call?
Okay, Max, can you hold that question till we get to the looking forward section?
Absolutely.
Because that is a very good question, but if we start answering it now, we're going to not have time for a lot of other things. That is one of the things that CalPERS is looking to do to be able to increase the probability that they can hit their 7% targets moving forward. And so we'll talk about a few of those things, but that's a very good question. Now I've been warned that you people actually read the papers. So we will make sure that we have answers to your questions later in this session. The volatility has been insane this year. This is a graph of CalPERS public equity program, combination of the market cap weighted and the factor weighted. And you'll notice that things were, during the first half of the year, the beginning of the year, things were relatively steady. And this is in January. If we actually pull this thing back to July, the returns were pretty solid and pretty consistent from July all the way through mid-February. A little bit of a dip in the beginning of February, but again, recovered quickly, solid returns. This was looking like a normal year. And then the world went crazy. Since February, 1 out of every 3 days the market was open, the market volatility, the market swung 1% up or down during, for 1 out of every 3 days between February and the end of June. That is completely unprecedented in market history. So we are going through crazy times. And as you can see from this, the market dropped 30+%, 40% from its peak in February down to the end of March. And we had conversations with some of you when you were seeing this happening as to what was going on. How much should you panic? Because when you see the markets drop like this, it is really hard not to get worried. And so we were hopefully during our conversations with you, we let you know that it's okay to be worried, that we need to watch it, that it's not as bad as things looked. And hopefully our voices were calm when we did that. At the end of March, the Congress passed some major stimulus bills. The Fed started pumping liquidity into the markets. They did this to get things to stabilize. And the Fed has been pumping money in at an unprecedented rate, and the recovery has been phenomenal. We'll talk a little bit later in the looking forward session as to whether or not we can expect something like this to continue. But the good news is that most of the losses were recovered. The other part of if you looked at this year was split very much between what happened from mid-February through late March and what happened between late March and the end of June. And that happened in all asset classes. So if we take a look at all the different asset classes for the equity markets, both of them, they had dropped 30+%. And then they recovered more for the market cap weighted, because stocks like Google, Facebook, Apple, that are a big chunk of the market, did very well because all of you are stuck at home and are spending all of your time on the internet. So that helped them very well, and since they're a big chunk of the market, that helped drive the market cap weighted. For high yield corporate bonds, they had, companies returns, their earnings plummeted, they were getting killed, and a lot of them had their ratings dropped because of the drop in interest rate and the stabilization of the markets. High yield corporate bonds recovered most of it. Long spread bonds, because action was being taken, the markets calmed and expect things, not necessarily in the short term, but in the long term, to recover. For the U.S. Treasuries, the Fed dropped the rates and caused the Treasury to drop their rates down to close to zero, less than 1%. That meant that we got a great return on those who already had bonds at that point. But moving forward, we do not expect bonds to do particularly well. They're now returning less than 1%. And moving forward, if rates stay stable, we're going to expect to see them continuing at about 1%. On the liquidity side, the amount that's in liquidity is in short-term risk-free money. It is like the money that is in your internal reserves. It is not supposed to go up or down. It's supposed to go up a tiny little bit. It is safe. And one of the great things that we see from this is that it was safe. They earned 0.2% for the amounts that they had, in cash. They earned practically nothing, give or take, since then. So this meant that their safe investments were safe. That's what we expect to see on that area of it. Overall, as we mentioned, they earned 4.7% for this year. For the 5-year average, they earned an average of 6.3. During that 5-year period, we had the last 2 years where they earned a little less than the 7. We had the 2 years before that where they had solid returns above the 7. And 5 years ago, 2016, was another sort of weak year. In fact, we can look at it, in the 10-year average. They earned 8.5. And again, the 30-year average, 8%. They beat the targets over the long term. 20-year average, and we'll look, actually, I'll just skip to the next picture where we have year-by-year returns for CalPERS with the line drawn in for their current assumed discount rate, which is 7%. What we see here in recent years, again, steady, it's been going down a little bit year by year. Since 2016, a little weaker returns each year. But again, they're pretty close to the 7% target. 2015 and 2016, we had weak markets. And as the economy was recovering during those times, the Fed was slowly moving interest rates up. So fixed income was having a slightly worse than expected year. Stock markets were not doing particularly well. Those are tough years to invest. But for those of you who have been doing this for a while, you'll remember 2008, 2009 were devastating to the markets and to CalPERS. After the 2009 year, CalPERS did a major review of its asset allocations to try and get their investments better under control. What had, back in the late 90s, when assets were shooting through the roof, CalPERS had plenty of cash available. They figure, oh, we are long-term investors. We can take risks in the market, and we want to take advantage of the great markets that were going on. So they pushed a little more into taking a little more risk. They figure, oh, during the years when the markets are going well, we'll hit a home run and we will do well. And during other years, our diversification will protect us and we will be fine. And they got hurt a little when the markets plummeted during the dot-com bust of 2001, 2002. But they picked it back up later. Then 2009 hit and they got crushed. And CalPERS reviewed and changed their philosophy moving forward. And so they wanted to make sure that they were solid, they were consistent, but that they never again were near the bottom of returns. And what we see this year with their 4.7 return, and we'll talk about this as we compare to other agencies, I think this year's 4.7% return is going to end out at the higher level of what public funds are achieving this year. CalSTRS yesterday announced their return. They got 3.9. Also, I think that's going to be above average. Many of the agencies, a couple of the other agencies that I've seen have been announcing returns closer to 1%. So the diversification that we've got going on here, the moves into private equity, the access to private equity here in California are advantages that our big California systems are trying to take advantage of.
And Ira, should folks be looking at just one-year returns or also long-term historical averages, and why?
Well, yeah, as we've tried to remind you in the past, a pension plan is a long-term investment. It is not a short-term investment. So first of all, going backwards on this to this picture, this is day-to-day volatility, which is insane. This is something to caution you about, but not to panic about, because if the markets are going up and down every few days, the day-to-day volatility is an issue. CalPERS only really focuses for your contribution rates once a year. So the once a year volatility that we show here is the marking to market that your plans do as you get your valuations. But your investment, the purpose of this is to have the money available for your retirees 10, 20, 40 years in the future. So it's more important to look over longer time periods. If we look at 5-year averages, what we see here, again, is a little more steady. Here you'll notice that the up and the down go from positive 25 to minus 25. This was a minus 24% return that CalPERS lost in 2009, the biggest that they lost in their history. For 5-year averages, you'll notice everything's positive except for 2012, which is a very slight negative. Everything else is a positive number. Positive returns over time, even during the worst of times, and much more steady, ranging between 0 and 16% there. So these are relatively steady, very close over time. And if we look at the 10-year averages, we'll see that the 10-year averages for the last couple years are beating the assumed discount rate. Prior to this, we had the terrible years in 2008 and 2009 that are, in fact, let's go back, that are hitting our returns right here. That 1 year of a minus 24, even though, going back again, 2010 and 2011 were pretty good, 2013, 2014, pretty good, but the averages were killed by that terrible year in 2009, just as many of your budgets were ruined by 2009. If we look at 10-year averages again, once we pulled the 2009 out of it in 2019 and 2020, since we no longer had that, this goes from 2010 to 2019, this goes from 2011 to 2020. This starts looking more like a more standard 10-year period that we expect to see. Every generation, you have something sort of traumatic happening. If we go back, for those of you who are my age or older, you remember the markets in the 70s that were just terrible. That, you know, again, happening, pulling back 30 years later, the kind of thing you expect to see in markets, the kind of market volatility every generation. And I'll stop going with nostalgia here as we move on to the next slide. So now, to answer the question of, does CalPERS do a good job with their investments? How does CalPERS investment returns compare to other public retirement systems? That's sort of the best way to understand if CalPERS is doing a good job. So to do that, we went and we grabbed information that was publicly available on publicplansdata.org. There is a public plan group with some, very, very diligent people collecting information from large public retirement systems. There were about 200 public retirement systems on the data. In order to make this comparable, we grabbed information from the 129 public retirement systems that all had a fiscal year end of June 30. So that market volatility, if it was up on January 1st and down on June 30, or vice versa. If you remember last year, the markets also took a strong rise right before June 30, which made last year into a 6.7% return, saved last year's returns. And we saw it again this year from March, April, May, June, that the markets took off during that period, saving this year. Having a June 30 ending rather than a January 1st or a September 30 allows for comparability. Now, to have this information, we've only got the information through the June 30, 2019 year. So this doesn't answer how CalPERS did this year because they have not all announced yet. But this gives you an idea in general, over time, how is CalPERS doing compared to other public agencies? Some of the names, again, there are 129 of them. We're just listing some of them here. So it's like Arizona, the state of Arizona, the PSPRS, the ASRS. We've got LA County, New York City. Some of you may have heard of New York City. South Dakota, you probably never heard of South Dakota. Again, big cities, big, small, public retirement systems, actually all large public retirement systems all across the country with June 30 dates.
And Ira, why would there be variance in return between different retirement systems?
Well, the reason that that there are different returns between public retirement systems are a combination of the fact that they have different asset allocations that they've decided on. Some of these agencies, some of these retirement systems have access to more sophisticated investments, like with CalPERS, where they're going into private equity and they're making strides in that area. Some of them have different allocations because they have slightly different time horizons. Some of them have more retirees than others. For those that have more retirees and bigger payments going on now in relation to their total liability, they're going to put more of it into short-term investments so that they've got enough money to cover what's going on each year to year. For those with fewer retirees, they have a longer-term time horizon. They can be a little more aggressive in the markets. So there's going to be some slight volatility. But as we look at the numbers themselves on a year-to-year basis, now what you see here, the red line at the bottom is the 25th percentile, sort of the lowest quarter of returns. The yellow line, maybe it's orange in the middle, is your 50th percentile. The black is the 75th percentile. So if you look at year-to-year returns, you'll see there isn't a lot of difference between the 25th percentile and the 75th percentile. So while there is some difference between agencies, most big public agencies have similar outlooks, similar investment structures. CalPERS fees, because they have pretty much all of your money, they can negotiate lower fees than most agencies, and having lower fees helps them out a little bit. What you see here to some extent, and as we go back, and I'll show that a little more when we go with the 5-year averages, is that the move that CalPERS made after the 2009 crash, their objective was to be close to the middle, to not fall below into the bottom quartile, which meant they were giving up the chance to be in the top quartile on a regular basis, to be consistent, and ideally be a little bit above average almost every year. And as we look here, we'll see a few years, like 2012, they had a rough year, they were in the bottom quartile. But most years you're seeing them hit right around here. 2014, they did better than most. I think again, 2020, you're going to see them in the top quartile, but most years you're going to see them right around the middle. CalPERS, because they are $300–400 billion in assets, they are going to be in the market. They have to be in the market. Their moves are going to move with the market. That's what they're going to be doing. So they are trying to be consistent, be long-term, strategically smart, and allow for better returns. If we look at the 5-year average and the comparisons, what we see here is that because of the devastation of 2009, they are in the bottom quartile for the years 2010, 11, 12, 13, 5-year averages that all include 2009. Once they made the shift in their philosophy and their approach and their allocation in 2010, you're seeing them on 5-year averages fall in, in the middle range for all this. We're going to start seeing this next one again. I think they're going to be moving up as the 2020. They did a pretty good job of dealing with all of the volatility this year, and turned out to be again, 4.7 is not a great year, but 4.7 is not a tragic year, which is what it looked like at the end of March.
And Ira, a question from the audience. For CalPERS specifically, as well as other retirement systems across the country, has there been an impact as systems have kind of started to move towards more socially responsible investment strategies?
That's a yes and no. The move to being to having some version of socially responsible investments was happening even in the 90s. To divest from, they were divesting from things like South Africa. They moved out of some of the tobacco areas. Part of it was being socially responsible, just because it's the right thing to do. Part of it was that even though some of those returns were solid, there are risks in there. If, like for example, in the investing in tobacco, there turned out to be a lot of lawsuits that the tobacco industry has lost, not as many as they could have, and that ended out hitting their bottom line, affecting shareholders. The amount of risk involved in being in some of these some socially irresponsible companies was financially not necessarily a good decision. But they have made some, in theory, they are supposed to be the CalPERS board is supposed to be focusing on the returns, and the thought that some of these, the companies that may not be socially responsible may end out getting hit down the road with liabilities is a financially responsible decision, but not all of CalPERS and other public retirement systems decisions were focused on the financial aspects of it. Some of it was just focused on their desire to be on the right side of an issue. Their desire that if a company is potentially not listening to shareholders, paying their executives too much, not paying their people enough, that fighting off unions, they did not want to be supporting that, so they were moving out of that. CalPERS also feels, in general, and this is what they reported, this is not me speaking for CalPERS, that they can do more by being a major shareholder and controlling the proxy votes than they can by divesting and having the rates plummet. So they have held on to some of these companies to try and help control the actions. But where they can't do that, they've gotten out. I do think that some agencies have lost some return potentially because they were trying to do the right thing. I do not want to, it's not my job to judge whether that is that trade-off is necessarily a good one. So I don't know if that actually answers your question. Hopefully, it at least gives you enough information to think about it moving forward. Just because somebody gets out of an industry that is doing bad things doesn't necessarily mean they did it just because these people were bad. There are also some dangers, some financial risks to being taking advantage of companies that pollute or other things. All right, let's move on to looking to the future. So we're going to do this in a few different steps. First, we're going to start with, let's treat this year as a one-time event and look at how this year's return of 4.7% impacts your UAL and the contributions you're going to be making going forward. Then we'll take this a step further and say, what if this last year is the new normal? As you start thinking about this, I do not, I'm not going to judge you if you start drinking at this point, because this was a really difficult year for all of us. And if we're going to have to live through too many of these, this is going to be, I've already gotten rid of all my hair, but it's going to be a tough thing to move through. But we'll look at the impact of that if we keep getting 4.7% returns moving forward. And then we'll talk a little bit about what to expect moving forward for the economy, for the markets, and for CalPERS. So let's look at this as a one-time event. So this is the quick summary of this, which is we were expecting a 7% return. We got a 4.7. We earned less than CalPERS was expecting to do. That means there's less money in your fund. Your funding percentage went down. For the average miscellaneous plan, we were expecting it to be at 74.2% as of June 30, 2020. Now it looks like it's going to be around 72.6%. We lost about 1.6% on funding. On the safety plan, we're expecting it to be 71.1. It looks like it's going to be around 69.6. So for you to sort of think about that, plans were about 70% funded. So you had $70 for every $100 of liability. If you fell 2.3% short, then it was 2.3% of that $70 that you lost, which is about 1.5, 1.6%. Which meant that your funding percentage is 1.5 to 1.6% lower than you were expecting it to be. If the plans were all 100% funded, then it would have been hit by a 2.3% drop. So this is the good news is you're not all as well funded. You had less assets in, and you'd have fewer assets to not do as well. So that's about as cheery as I can get. So let's look at it now for individual plans, doing a projection for an average retirement system. So we grabbed one of our systems that was 70% funded on miscellaneous plan and safety plan. That agency was expected to have a contribution of about $14 million in the 2024-25 fiscal year. The 4.7% in this return for that 1 year, instead of getting 7, meant that over the next 25 years, that agency is expecting to pay an extra $11.6 million. So it's about 10 months of extra contributions that you would be making because of this 1 year falling 2.3% short. So if you want to sort of get a rough feel, and again, and that's compared to the 2024 number. If we compare it to the 2020 number, it's about a year's extra contribution. So if you think about what your contribution is this year, you're basically going to pay that amount extra spread out over the next 25 because the investment return fell short for 1 year, if everything then returns to normal. On a funded percentage basis, as we were saying before, there's a slight increase that we expect to see. So, and because of the way CalPERS amortizes the investment gains and losses, you may remember that CalPERS changed their amortization approach beginning with the June 30, 2019 valuation. The June 30, 2019 valuations are the ones that you will be receiving electronically in August. And they will be August of this year, 2020, and they will start to impact the contributions that you pay beginning July 1, 2021 for the 21-22 fiscal year. And what they did, beginning with unfunded liabilities that get created with this valuation, new unfunded liabilities are amortized as a level dollar amount rather than as a level percentage of pay. They also are, they got rid of the ramp up and the ramp down for all reasons that unfunded liabilities get created, except for those created for investment gains and losses. The biggest cause of year-to-year volatility in contribution rates for a pension plan or a retiree health plan is due to the investment returns being volatile, the volatility of the markets. So that there is still a ramp up that is put in place for investment return gains and losses. And that means that you're not going to pay the full cost of this year's shortfall until 5 years later. So again, the loss from this year is going to be accounted for in the June 30, 2020 actuarial valuation. That valuation will appear electronically to you in August of 2021. You will begin to pay 20% of the amortization amount beginning in the 22-23 fiscal year. You'll pay 40% the next year, 60%, 80%, and then 100% of that amount in the 26-27 fiscal year. So you're not going to pay the full cost of this until the 26-27 year. So what this means is that, first of all, that you have time to think about how you're going to deal with this type of loss, which is good. You're not going to end out having have it fully impact your budget for a number of years, which means that by the time you have to pay the full cost of it, we will hopefully be out of the COVID recession that we are under right now. Your budget will have recovered. It also means, though, that the costs are going to keep going up. And when you, let's go back to looking at costs, these amounts are, the gap between these two is growing. Contribution rates for most systems will continue to grow until right around 2030, where for most retirement systems are now going to be hitting their peak, give or take a year or two. So if you don't want to deal with these top numbers right here, when the economy recovers in this period, you may want to start taking steps to start prepaying contributions again. When your budget has recovered, when you start having excesses again, like we talked about a year or two ago, that's the time to start preparing and giving, sort of paying off the top amounts of this so that you have more flexibility for future budgets, and that you aren't hit as hard when the next recession comes, which hopefully is not anytime soon. Okay, so now that's just 1 year. 1 year of this is not that bad. But what happens if this is something that's going to be continuing, that we're going to have consistent 4.7% returns year after year after year? And the short answer to this, as I'm about to show you the picture, rule of thumb, as we started looking at, one of the great things about having the software that we developed here, and I don't want to turn this into a marketing pitch, but as somebody who studied this stuff for a large portion of my career, to be able to look at and find sort of quick rules of thumb as to what happens to agencies, at what point are you not going to be paying off your unfunded liability. Roughly, if your returns are consistently 2% less than what's projected, you are not going to be paying off your unfunded liability. It's going to be growing faster than you're trying to pay it off. And we're seeing that here in the results, where because the drop, this is 2.3% less, it's more than 2. we expected the unfunded liability to rise. We are seeing it rise more as the phase-in period occurs for this, and then it continues to grow. And even as you are forced to pay this off in level dollar amounts over a 20-year period, it is still, the investment losses are still coming faster than you are paying them off. If the asset mix that CalPERS has starts to consistently, year to year, return 4.7%, you're not going to pay off your unfunded liability under any normal thing. You're going to have to come up with approaches on your own side because the investment returns and the normal amortizations are not going to cover these things. This also means that if it looks like this is going to be happening and everything that CalPERS does to try and get better returns does not work, then we can reasonably expect somewhere down the road CalPERS to lower their discount rate somewhere closer to the 4.7% that we actually are achieving. We're showing this because this is just the answer to looking at what happens. I'm not saying that this is what is going to occur. And I'll talk in just a moment about some of the things that we do think are going to occur. But this is so you understand what is happening, what may happen. It also means as these rates go up, as your unfunded liability goes up, you would expect your amortization payments towards unfunded liability to also continue. So we look at the contribution rates and we see the same thing, that contributions that we're expecting to level off and start going down as amortization bases get paid off. Instead, as new bases get created year to year because of this hypothetical 4.7% consistent return, you would expect to see rates continue to rise. And again, remembering that this agency is paying about $12 million a year right now, this means over the next 25 years, you're going to expect to pay an additional $166 million, which is about 13 years of extra payments over 25 years, meaning you are paying 3 years worth of payments every 2 on average over time. This gets to be very, very expensive. I guess the good news is if we go into a hyperinflation environment, which destroys a lot of other things, then dollars aren't worth as much. But that's the only good environment where I would potentially see this being affordable to agencies. Again, I don't expect to see this happening. But if it does, this is what happens from it. So now let's take a look and talk about what we think is what some of the things that may be happening going forward. Let's start with one picture this is from CalPERS webinar yesterday. This is a picture that helps show why it is going to be very, very difficult for CalPERS to earn their 7% moving forward. The line here are what 10-year treasuries have earned over time. For most of you, we've been working in sort of this time period where they were about 5% in early 2000 and have dropped and again plummeted in the last couple of years down to 0.6. If interest rates hold steady moving forward, we expect fixed income to earn 0.6% moving forward. When the economy eventually recovers, the Fed is going to start raising rates. The interest rates will go back up. When that happens, the fixed income will start losing money. And that makes it tougher. So in a steady environment, we're going to expect to see a 0.6% return. In a positive environment, we're going to expect to see fixed income, which right now is 28% of their portfolio, losing money. Back in the 70s, in fact, if we pulled this back further, prior to 1966, public retirement systems were only allowed to invest in fixed income, short-term fixed income, just like you are on your internal reserves. California passed a law in 1966 that allowed public retirement systems and technically retiree health systems, but nobody was funding those back then, to start investing in things like stock and other areas. By 1970, they still had 89% in fixed income, 11% in equity. The returns were about 6% back then. For those of you who were around in the late 70s, when Paul Volcker basically had the Fed try and kill the recession that we were going through by shooting short-term interest rates through the roof, 10-year treasuries were earning 14%. Since then, they have been going on a steady decline, consistent, with a little bit of volatility, but consistently down till we get to the Fed making their move right now to help try and get us out of the current COVID recession, and dropping it down to practically nothing. Over time, CalPERS, as these rates have gone down, as the low risk investments earned less and less in order to be able to achieve the better return, CalPERS put more and more of their money into the stock market. And then started slowly shifting, trying to keep it again steady as about a quarter, maybe a third of the money over time. Because it is, we cannot expect to see these the fixed income helping out much. It's going to help with the volatility. It's not going to help with the returns. CalPERS needs to get better returns from their other asset classes. CalPERS is doing, that's one of the reasons they moved into private equity. They have that is one of the asset classes where they expect to get better returns over time. And as other agencies, other investors start getting out of those because they don't have the cash, CalPERS is hoping to hop in and take advantage of some of the better ones and be able to achieve some stronger returns in those areas. They also have the ability, when they feel that the market is going to be strong overall, to do a little bit of leveraging, to invest $120 for every 100 they have by borrowing a little money and putting it in stock market and related things. That is part of what they did to help with this year's recovery. And that's part of what they're looking at moving forward. Over the last few months and the next few months, CalPERS is making some moves and some short-term changes to be able to increase the likelihood that they will be hitting the 7% target. That is their current approach to dealing with this. And by saying that, that basically indicates that they're not going to be moving the discount rate in the short term. But it is CalPERS's policy to take a significant look at the asset allocation and the economic assumptions every 4 years. And that means that during 2021 is the time period when they would normally look at all of this. So they will be looking at this carefully in the 2021 year. So starting, I think they start with workshops in January. They started making more public announcements as they get closer to June. We're going to be hearing a lot about CalPERS changing their asset allocation, making moves, and those will indicate whether or not, if they start becoming a little more conservative, if they have their advisors telling them that the markets are not expected to be recovering, to be moving forward positively, then they're going to be dropping the discount rate. They won't be doing it until, till probably they would be deciding it in 2021, probably at the earliest, impacting the 2022 valuation. And if they're doing anything significant, they will probably phase it in like they did with the most recent changes over a 2, 3, 4 year period, so that you have warning and you are hit more slowly by this over time. I will say, again, I don't want to be projecting the markets, but historically, right now, let's back up to historically. Right now, The stock markets have done very, very well, but the economy is doing very, very badly. Over time, those two, the economy and the markets, tend to move together. Because of the liquidity that's been put in the markets have been able to move up while the economy is still going down. So at some point, those two things need to come together. And that either means that we need to have more stimulus put into the market to get the economy to come back up to where the markets are, or at some point, if we do not recover in the economy, the markets will come back down to the economy. That is one of the things that we're going to be looking at very closely over the next few months, over the next year or so, to see how things are recovering, to be able to better understand where things are going. But there's a lot of uncertainty. And as you try and think about how you're handling things, this is a good time to be able to, again, take advantage of the tools you have, like the software, to be able to look at a bunch of different returns over the next couple of years, lower returns moving forward with a lower discount rate, and other things to be able to prepare you. If this is one of your top 5 issues, you may want to look at it sooner. If you have other things because of revenue drops, focus on getting through the short term, stabilize things. Remember that these changes are not going to hit your contribution rates for another 2 to 3 to 4 years. You have time to be able to think about them. You don't need to address them all now. But when you start being able to take a breath, have it on your list to do things. So anyway, hopefully we have given you good information and not depressed you too much about what the future will look like. Max?
Just want to open up the floor for any last minute questions. Of course, if anything comes up after the webinar, don't hesitate to reach out to us then as well. I'll give it a second here.
If we didn't get a chance to answer your questions in the webinar, we will try and do this by email.
All right, looks like good on the question front. So we want to thank everyone for attending this webinar. We look forward to you all attending next month's webinar. And of course, as Ira said, if individualized presentations, support, or analysis around CalPERS related topics is a major issue, or you anticipate needing some more support, don't hesitate to reach out to us. We've already done individualized presentations for a fair amount of folks on this call, and we really want to make sure that everyone on the call can take advantage of that. So we're here to help.
Right, and if you want, and if your team or your board, you feel they need to hear these messages, invite them to come listen to these webinars or have us do personalized sessions for your agency. Again, we're happy to do that to help educate and make sure that you're ready to answer the tough questions.
Perfect. All right. Thank you, everyone.